tonight, tomorrow, this weekend, when you get the chance, I want you to study big gap downs after bear candles into new lows. That's what I want you to study. We're going to do it together. We're going to go look through some, because most of the time when traders lose a bunch of money that I've noticed is when you have gaps on the broader markets, large gaps in one direction or another. So let's talk about it really quick on the SPY. Bear candle, bear candle, bear candle, bear candle, bear candle. How many is that in a row? Sam, give it to me. How many is that in a row? All right, that's 5. So when we gap down 2.5% this morning, are those bears profitable or not? Okay, those bears are profitable. So what do bear profit? Right? So the fact that we retested, we filled the gap. So I bought some puts there at the orange line. I'm in those. We'll see what happens. I'll buy some at the end of the day off the 200 simple, and we're going to go through the Qs and the SPY and all that. But it's not really surprising, because most traders, those who lost money, are because you bought puts at open and then you sold right here. I sold the puts at open. This is when you buy puts up here. So you buy puts, you buy puts, you buy puts. This is when you sell puts. It's really it. That's it. I mean, you could have bought a put in here because that's 2 candles in a row. You could have bought a put somewhere in this general range, right? Which is just essentially saying, hey, let's see what happens if CPI comes out bearish. That's really what you're doing. But when we gap down like that, you have to take profits. So again, let's just go practice. Let's go look at other situations and instances where the market has multiple bear candles in a row and then gaps down. So here's another one. 1, 2, 3. So you had 3 bear candles in a row, big gap down. It did go a little bit lower. Now you'll notice we did end up retesting before we went down one more time. And then that doji was a low. We end up filling that gap and then going higher. So that's one instance. Again, let's just go. This is really easy to go look at a few more. We're looking for multiple bear candles that gap down into specifically a new low. That's what we're looking for. Multiple bear candles that gap down into a new low. So here's one. 1, 2, 3. Gap down to a new low. What happens, boys and girls? Keep in mind, you could have done all of this before market open. All this before market open. Like you're going through, like, okay, we go look at the history. Like, let's see what happens when markets have a bunch of bear candles and they gap down to a new low, especially the broader markets, the big picture. Because the last time I got as many texts as I got today from losing traders, really, like, oh, what do I do? Why am I losing so much money? What's happening? This was back in February when this happened. 4 bear candles in a row, gapping down, opening into a new low. That gap also was about, ready for this, 2.5%, give or take. 2.5, right around there. Bunch of bear candles gapping down to a new low, because bears, they get in high, and what do they do low? They buy low. Because this candle looks exactly what today's candle looks like. And I'm still going to go over some bear positions, and I'm still going to look at some stocks. I'm still going to tell you what I'm in as well, what puts I did buy today, because I did buy puts, but not at open on anything. I didn't buy puts on a single thing at open. I bought it after a retest because it was a retest gap. I mean, same thing I did on that day, by the way, back in February. I mean, I didn't buy puts here. Again, let's just look at the chart. Let's just analyze it. Because before we do, let's look at this here in black. On the black arrow, was there another time that we could have analyzed that had a bunch of bear candles gapping down into a new low? Is there any other time that? Oh, this one? Got it. Right. Type in one if you see it though. Bunch of bear candles gapping down into a new low. All we're doing is practicing. That's it. We're just going back and looking left. We're practicing the process because this will happen again. Today is not the only day. You're going to get a million other opportunities to do this. But no, I'm not bullish at all. Not even close. I'll go through all the reasons I'm bearish. But I can easily see the next 2-3 weeks doing this and this, or this and this. In which case, as we get a little bit higher, I'm gonna get into more puts. And when that rollover comes in and we get back down to roughly the same low or near the same low, and I'm profitable, I'm gonna get out. All right, let's keep going. Let's go back a little bit more. Okay, let's go to this one. Bear candle, big gap down into a new low. What do we do? Same thing. Same pattern. Right? Shorts, they freak out for a quick second. Shorts cover. Everyone freaks out. It runs higher. We fill the gap. We roll over. All the bears are closing, taking their profit because you have a new low. Right? New low, profitable position. And again, I'll go through a lot of my positions. We're going to go through them today. I got filled on a lot of my puts, but not all of them. So I'm going to keep holding and we'll see what happens. The way you deal with your emotions is you plan, right? You create the plan for ahead of time. What's going to happen ahead of time? What are you going to do in the future? Let's go look for a few more examples. Michael says, do you buy calls on any of these bounces? It's up to you. You can, it depends on the trend. You can day trade. I mean, today would have been a great day for a day trade. All right. So now we're going back to 2020 or something. Let's go look through a bunch of bear candles making a new low on a gap down. I don't really have any examples over here. This is a kind of an example, but it doesn't make a new low. So we can see it right there. There's the pivot. So it didn't make a new low. This gap right there is what I'm referring to. Just looking for new lows, gap downs into new lows. COVID was an awesome example. COVID's a great example. All right, let me just go back to COVID really quick. Because again, you're thinking to yourself, oh, this is the first time Jeremy's ever done this. Not from like a gap standpoint. Look at COVID. Bear candle, bear candle, bear candle, bear candle, gaps down to a new low. You guys remember how many people like lost so much money on this day? And it was kind of mind-boggling to me. I think this is what's going to happen right here for where we are right now. We're going to go through some more examples, but that's what I got. Type into 6 if you can see that during COVID. If that makes sense. Because again, all this is practice. When I talked about yesterday and Monday and last week, talking about ask your wife, talk to your wife, start planning. This is what I mean was for today. Like, this is fantastic. This gap down, fade up is perfect. Like, you couldn't have asked for anything better. But you didn't want to get embarrassed at open because it had already made its move. It made a new low. Buy low, sell high. Don't sell like hope, So this is a beautiful example. Even though right here on this particular day, this is not bear candle gapping down, the circuit breaker hit on the broader market that day. We were down so much, the market turned off. So again, just look at the pattern here for a second. Boom, boom, boom. Is this the day to buy puts? No. Now, hear what I said. is this the day to buy puts? If you want to buy a put, just in case it keeps going lower, fine. Like one contract, okay, cool, great. But you don't want to get in bearish on new lows. That's what I'm really trying to hammer home. On this day here, this is the day for the conversation with, hey, wife, hey, husband, something's up. This is the day for that conversation. Something is happening. This is a big, big deal. I don't know what's going on. I need to start planning it. And then the next candle that came in, the gap filled, even though it was a gap and go. And tons of traders were like, oh my gosh. So many people lost money on this day. And again, it was kind of baffling to me. I'm like, why are you guys losing money? I mean, they shorted down there, and it rallied. Like it was just a great day for, again, practice, looking at, analyzing. Now that day was up 7.2%. This day here. So if you guys think today's rally was bad, I didn't even notice it. I barely even put up my trading view after 9:45 a.m. Like this wasn't even a rally. This was a nothing. Can you imagine a 7.2% up day? If you're getting in short, because again, a lot of people shorted down here. That's not the time to get in short. You sell high. And then the next day, all those bulls got taken out. There's a very, very distinguishing factor on these 2 days right here. Circuit breaker happened again right there. Is that the time to get in bearish? The most bearish day of all time? Hopefully not. Up 10.4% the next day. You think what happened today was a rally? What are you talking about? You guys didn't back trade some of the crashes? This was crazy. It was wild. And then bang, circuit breaker again. Get the point? This is what bear markets look like. This is what, not bear. Well, yeah, bear markets, bear drops, whatever. This is what they look like when you're gonna have big drops low. They're gonna make new lows. You're gonna have a rally into the old support, new resistance, and the face is gonna get ripped off on things. And it does that until you get capitulation. And capitulation is that final push where everyone feels the most bearish. And that was this day right here, March 23rd. All right. So how do you day trade today? That's what Justin's question was. If you have to, if you need to. All right. So what I'm going to do first and foremost is I'm going to go to reallifetrading.com and I'm going to go into the account and I'll just give you a strategy. You don't have to use this one. It's up to you. Totally your call. It's a really, really good PDF with a lot of great rules in it. This PDF is the 10 EMA. I have some little cool things on here. Where is the 10 EMA? 10 EMA strategy right there. It's under free resources. You can click on that and I'll show you exactly how you could have used it. I'm not saying you had to. I'm saying that this is what you could have done if you wanted to. Up to you. But you would have been able to trade early because you were waiting for a gap below the low of the prior day. So the gap below the low of the prior day happened. Okay. So the right-hand side chart is the extended hours. The left-hand side chart is the non-extended hours. All right. Now we go back over here, 10 EMA strategy. We're clicking on this. We download this PDF. Look how long that took. That was really quick. All right. Setup. So we have the setup. Bear candle closing above the 10 EMA on both extended and non-extended hours. Again, I'm not saying you have to use this, but for those who are like, oh, how could you have traded the day? You would have had no idea knowing. I mean, I guess maybe. All right. Where's the first bear candle that closes above both? That would have been right here. This is the first bear candle that closes above moving averages on both time frames. Now, I agree that at that point in time, you would have been a little bit on the high side. But even if you bought there without buying an S curve pullback, none of that, and your stop loss was below there or below here, you would have gotten very, very close to getting stopped out, but you didn't. It wouldn't have worked. So that's one strategy, Justin Williams, since you're asking, right? It did work. The 10 EMA, again, just at open, did the stock gap above prior day high? No. Or prior day low? Yes. Okay. So it did gap a prior day low. Yeah, prior low day. So gap below the prior day low. So all right, let me go to rule number 5. Rule number 5, using a 3-minute chart for entries, bear strategy, bull candle closing below the 10 EMA on both extended and non-extended hours. All right, well, let's go over here. What was the first bull candle to close below both? Literally didn't happen on the extended hours until 11:21 Central. That's noon 30. You didn't have a bull candle close below the 10 EMA on the extended hours chart, because you have to have both, right? The extended and non-extended, until 12:30 Eastern. Type in a 7 if that makes sense, team. Now, again, remember, this is free for you. You can download this PDF. It's available right now. It's up to you if you want to follow the rules, but it's a very, very, very good guideline. I spent a lot of time making it. It's not like it just, it works. It works because this is how you trade these large gaps. These large gaps are going to take time to really settle into the moving averages. As Ed says, if you're worried and you have no idea what to do, just don't day trade that day. That's also what you can do. Or number 3, if you are expecting a bunch of bear candles to gap down, we have tons of bear candles gapping down into a new low. What's the sentiment? The sentiment is fade. That's the sentiment. So the very, very first 3-minute candle, you have tons and tons and tons of bear volume coming in. The next one takes out all that bear volume. Be looking for a long. Next candle, hammer, bear, inside candle. Remember, on the daily chart, 5 bear candles in a row on a daily chart, gapping down into a new low. Broader market's down 2.5%. So your choices are 2. Don't do anything or go bullish. If you're going to go bearish in this scenario, you have to wait for something pretty dramatic, because you should already be in bearish if you're in a swing trade. So don't have FOMO. Right? There's no reason to have FOMO because you're already in on it as a bear. Or again, you can just keep waiting and go, all right, I don't want to short because we're already down so much. We have 5 days in a row. I just don't want to short. So I got to keep waiting. Is that making sense so far, team? So it's just looking at the charts, looking at the daily charts, practicing. Now, what if you took nothing bullish at all today? You didn't play one bullish day trade. That's fine. That's me. I didn't take one thing bullish today. So I lost nothing. I closed my shorts at open, a lot of them. We're going to go look at a few more. I closed my shorts at open. And once I didn't play anything bullish. So again, no day trade. And when the gap started filling and we started coming in contact with the 200, I bought some puts, and I bought some puts at the close of the day. So now we'll see what happens. But those puts are just with profit that I made from this move down. Because again, I was already embarrassed. I bought puts up here. So you buy puts up here, you sell them down there, you're profitable, take the profits, and then do it again. That only works if you make money on this move down and you use that money that you make to kind of reinvest your position, AKA free puts. If you made, and again, this is what most traders will do incorrectly. Just as a reminder, they won't short here. They won't short here. They won't short here. They will short there. They'll close their position here, having made, whatever, $3,000. And then they'll buy $8,000 worth of puts there and $16,000 worth of puts there. And then we'll go a little bit higher, right? We'll squeeze those traders out pretty easily. They'll end up losing 10K and they're down $7,000. This is what 99% of traders will do. Now, everything I'm going to say, most of you won't do anyway. And again, I know that's unfortunate and I don't want to be that. I don't want to sound mean, but that's kind of the truth. But I'll fill you in anyway on exactly what I think is going to happen next and precisely what I'm going to be doing. Because everything I say, I do. All right, here's what we got. First and foremost, we're going to talk about the SPY just for a quick second, and I'm going to look at the Qs because I think the Qs is the most important thing. The SPY did trade down to essentially a random moving average, which is the 200 simple on a weekly chart that was adjusted for dividends. Type in a 9 if this line was on my screen, not only yesterday, but this week and all of last week and the week before. It was there. So, I mean, it's not like you've seen it. I saw it. We talked about it. So if you had SPY puts and you wanted to sell one or many there, you could have. I'm not saying you had to, but you could have. But it was there. I promise. All right. So again, if you sold one, some, or all, or whatever, great. I don't have SPY puts for no particular reason other than Q's been going down faster. That's it. I don't have any SPY puts. That doesn't mean I'm good or bad or better than you. It means none of that. It just simply means that I don't have any. All right. So if you unadjust the chart for dividends, we have an amazing hammer, right? We did make a new low. We did close below. This is a beautiful, beautiful, beautiful hammer. And granted, we have one more day for this to close on a weekly chart. And I don't know how it's going to close, but if I had to guess, it's probably going to have a little bit of an upper shadow tomorrow. We're going to rotate down and we're going to close with a little bit of a bigger upper shadow, but still a bullish candle like this. Most likely that's what's going to happen because today was a news event. The news was terrible. We gapped down and all the shorts were like, well, I'm very profitable, so let me cover. That's what happened today. So now I'm going to go to the Qs because again, I'm not going to trade the SPY. So I'm just going to let you all know what I'm going to do on the Qs. And in order to really, really fill you in, I'm going to back out of here and we're going to go into the weekly chart. So the left is going to be present day. The right is going to be 2008. Okay. The right is 2008. And again, I do not know what's going to happen for sure. All I'm doing is I'm telling you my plan. And the reason that I shorted here at all threes, when I had on my chart, short everything. Oh man, that was good times. Was because looking at the 2008 market, we came down here, we bounced after a new low, and we broke above. Right, we kind of started rallying higher after we made a high and a lower high formed. So that move in 2008 was a bounce off the 200. What it was 22%. The bounce from here that was almost off the 200 up to here was 24%. So remember that time where we were losing money a lot on the puts, especially if you were in Tony's Premier group and you're like, oh man, what should I do? Like, this is really, really bad. Because it had that 5% deviance. I remember that. Type it in 2 if you remember that. I know you're either in Tony's Premier group or you're trading puts with me or you're waiting for it. And that was happening. But in the 2008 move, right, you had the 20% move up. And in 2022, we were up 25%. Okay. All that being said, none of that being that important. Let me hide this for a second. Okay. All right. This would be hilarious, but I don't expect it to happen. But if it does, it'd be very, very funny. we have 1 week to one more day to form. And I think we're going to form a candle that looks like that. I think we're going to close with a bullish candle this week with a little bit of an upper shadow and a little bit of a lower shadow. I mean, this is where we're at. I'm just letting you know. We are below the 200. This is a big deal. Type in a 4 if that gave you a little bit of goosebumps. I think that's a very, very good chance of happening. Now, I'm not saying that we're going to roll over next week and we're going to have the greatest sell-off of all time. I'm not saying that. What I am saying, though, is if we have weakness next week and we do not go higher than whatever we form in tomorrow's candle. So what if it's Friday, if we don't ever go above that candle, all of next week, I'm buying puts every day, every single day next week. Especially if we stay below the 200 simple. The only reason I know that is because that's what happened last time. Darian says, how far out? You already know the answer to that, my brother. Go ahead and write it down. What's the expiration? I've been telling everyone since August, the options that I'm buying. Yep, you got it, bro. You already knew the answer. December. We don't need to buy that much time. So that's what I'm getting at. So I'm still looking at, I'm comparing this to the last time the Q's closed below the 200 simple. That's all I can do. That's it. I don't know anything else. The market hasn't closed below the 200 simple since 2008. So I have no clue what's going to happen. So the only thing I can do is look at the last time it did it. Type in an 8 if that makes sense. Because I'm keeping these two screens side by side. I'm just saying, if this, then this, if this, then this, if this, then this. All right, Newsome, what happens if we rally out of here? I'm going to have to figure out, it's going to be some version of this again, where we came down to the 200, we bounce up to the 100, we bounce up to the 100, we failed the 100, we failed the 100, we came down to the 200, and we bounced. Is that possible? Yes. Boy's not a fortune teller, my team, right? All I do is mitigate risk. But in 2008, this was the peak right here. We never went higher than that. So if this is the case, and we have another huge rally coming, or this sustained a bear trend, I know we can't go above this high. That I know to be sure. We cannot go above that high if we're going to stay in a bear trend. We have to form a lower low and a lower high. So the price that I will be getting into, once again, as many puts as I can afford, essentially is 292.92. 292.92. And if we go up to 300, I will lose money and I will exit. And I will be buying the same options that I'm in now. 265 December puts. And if in the next 2-3 weeks, we never get above the high that we formed last week when I bought another large tranche of puts, if we can't get above the October 3rd high and we stay below that high and we stay below the 200, I'm going to be dripping on my puts frequently, lowering my stop so that if we have for some random huge bull day, I'll get stopped out and I'll lose money. But if we roll over and we continue to fail last week's high and the 200 like we did in 2008, I'm going to continue to drip on the puts, meaning buying more. If that's beyond your risk exposure and if that's beyond your comfort level, that's okay. You can short shares. You can short 2 shares and then 4 shares and then 8 shares. You don't have to buy puts. You can buy shares of the SQQQ, SQQQ, right? So you can buy 3 shares, 10 shares. I get it that your risk exposure is different. I totally understand. But the reason that I risked hundreds of thousands of dollars worth of R's up at this level was, yes, experience. Yes, I have the money to risk. Yes, it took a long time to get to that point, a long time. I get it. What you want to do is build your brain for you in 10 years. That's what you want to be building. You want to be building you in 10 years so that as you make more money over time, even if it takes you 10 years from where you are now, that money that you make, you can start buying assets with it that can cash flow, that are tangible, that appreciate over time. It can be stocks, it can be books, it can be coaching, it can be real estate, it can be your network, it can be masterminds, it can be Airbnbs, it can be rental properties, it can be flips, it can be wholesales, it can be stocks, it can be cryptocurrencies, it can be bourbon barrels, it can literally be anything. It can be a new job, right? There's all kinds of things you can buy with money. Duh. So I understand, but that's why I want you to have that conversation with your wife or your husband. Go, yo, here's the chart. Show them the chart. See what she or he says. And try to find out like where you think you should play this and what do you think you should do, and study the past a little bit. I get it that it's always easier in hindsight. Trust me, I understand. So if you feel scared, if you feel like you don't know what you do, and you feel really, 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 really certain on the direction, close the computer down because the market has blindsided you. True that. If you look at a chart, you're like, easiest thing of all time. I've been trading for 2 years and I know exactly what's about to happen. Dog, you haven't even almost worked enough to know. You haven't even gotten close. 2 years? I traded Apple for 2 years. You've been studying for 2 years and you think you're going to pull up the market and you're going to know what's about to happen? I'm sorry. I had one ticker for 400 trading days. You know, like 2 years. The people that make all the money doing this, they've been doing it for a while. They had to survive the grind, and in their brain, they now know what they need to do, and they know with certainty, and they do it with extreme discipline. That's the key. Because looking at the cues now, going back over here to the weekly chart, I am still bearish. We have made a new low. And I do think that we can trade higher, and I do think that we can and will continue to go lower. That's just my opinion. I don't see anything that would shake me from that. And even if I adjust the chart for dividends, we're still below the 200 simple, even adjusted for dividends. Jose says, why do you trade the Qs instead of the SPY? I have no answer for that, honestly. I had to pick one and just play it. There's no real answer. I think the Qs are weaker than the SPY because we've gone down more, but trade the SPY. I don't know, whatever you want. Albert says, better if the war ends. If the war is over, that would cause a move higher in the markets. Yes. For sure. That's a good thing. This is the monthly chart. So you have a perfect indecision doji at the 50 on the monthly. If we retest this, right? Because again, remember, look at the charts. Bear, new low. So boom. Retest into here is perfectly reasonable. The moving averages come down. Takes a little bit of rollover. That's fine. Understandable. Acceptable. I get it. Weekly chart. It looks in the daily chart. I mean, it's a good close. It's a good news event. I love this bullish volume. And yes, obviously, if we take out the low of this candle, it's going to be a hemorrhage, but for a day or two, because in order to go from here to here, closing below this candle, that would be an 8% drop. Just as an example, if we go up to the 20 EMA and then we close below the 200, you'll have 1, maybe 2 days of selling. Maybe. Because that would be a new low. The trend is bearish. You don't have to wait for the trend to be confirmed. You already know what the trend is. I've been telling you the trend's bearish for months. Meaning you don't have to wait for it to make a new low to short. Team, this is it. So back to the line, 292.92. I don't think it's going to get up there. I have no idea if it will. But that'll be the price for me, because at that point, we'll have moved 15%. Right? We'll have moved 15% off of the lows. We'll be battling the 100 bottom. The risk reward will be really good there. This is where I'm going to have essentially $600,000 of risk on puts. Meaning if it goes a lot higher, I'll lose 600 grand. You don't have that type of risk. Don't take it. If you do, do it. If you don't, don't. If it's a version of that, if it's 60,000, if it's 6,000, or if it's 600, that's okay. But I'm letting you know that's what I'm going to be doing. If you don't have that type of risk tolerance, you don't have that type of leverage, you don't have that type of cash flow, you don't have that type of discipline, you don't have the type of whatever, that's okay. But because I'm still a small tadpole. I'm tiny, itty bitty. There's gonna be people who are gonna be in $600 million of risk up there. 600,000. I mean, what is that? 225 contracts? That won't even show up on the radar. I'll barely make the order entry flow. Yeah, stop loss would be this gap right here. Type in a 2 if that's just like heartwarming to know, like that $600,000 is not even going to show up. It wouldn't even flash on the screen. That's how much money's out there in the markets, team. Today, the SPY moved $1.5 trillion worth of value. 1.5 trillion. That's with an L. Trillion. A lot.